New York City. It's famously the city that never sleeps, but right now it feels like it's absolutely roaring, especially if you look at the rental market.
Oh, definitely.
We're talking rents that are just, well, skyrocketing. Figures that honestly seemed impossible a few years ago. Think like $5,000 a month for a standard one-bedroom.
It's staggering. And it's creating this massive crisis. People are being pushed right to their financial edge.
Yeah, priced out completely in many cases.
But what's really wild, almost unbelievable, is the turnaround. You have to remember just a few years back during the pandemic peak.
Right. It felt like a ghost town sometimes.
Exactly. Over 100,000 people fled Manhattan alone. We saw landlords slashing rents 10, 20. I even saw 30% cuts on listings.
Yeah.
Honestly, a lot of people, myself included, kind of thought, okay, this is it. The city's over. There was this feeling it was like a permanent shift.
The death knell, people called it. Remote work was going to change everything.
But here we are, and it's a totally different story.
So that's our mission for this deep dive. We want to unpack this incredible reversal. How did New York go from seemingly over to this massive remigration?
Yeah, who is moving back, and what does it all mean?
Exactly. For people living there now, for people thinking about moving there. And we've actually got some, well, pretty unexpected insights about the real estate market that challenge what most people think.
We're going to dig into the forces driving all this and why understanding it is, frankly, pretty crucial for you, whether you're involved in the market or just watching this urban drama play out.
Okay, so let's rewind a bit. Back to 2020, 2021. That pandemic exodus, the numbers were pretty stark, weren't they?
Oh, absolutely stark. Manhattan lost over 100,000 residents in a single year.
Wow.
To give you some context, that's 5 times bigger than the largest annual loss they'd ever seen before. It was genuinely unprecedented.
An exodus. And that mass departure, it directly hit the housing market. Suddenly, those famously high New York rents, they started falling.
They really did.
Yeah.
You could actually find Zillow listings advertising, like you said, 10, 20, even 30% off.
So for a short window there, 2021, maybe early 2022, it was surprisingly, well, affordable isn't the right word maybe, but more affordable.
More affordable, exactly.
Yeah.
Relatively speaking, for New York, it was a renter's market, briefly.
And the thinking back then, the sort of common wisdom, was that remote work would change everything permanently, right? New York wouldn't recover.
That was absolutely the prevailing narrative. The idea was that cities, especially dense ones like New York, had lost their core appeal. It felt like a fundamental shift.
Clearly, that prophecy didn't quite hold because the energy now, you can feel it. People are back in force.
They are. It's undeniable.
So what's pulling them back? Is it just the jobs? Or is there more to it?
Well, the huge driver, you can't ignore it, is the return to office push.
Right.
Major companies, think J.P. Morgan CEO Jamie Dimon, being very vocal about wanting people back in the office 5 days a week.
Yeah, he's been banging that drum.
He has. And it's not just them. It's a wider corporate trend that's literally pulling people back into physical workspaces in the city.
Okay, so the jobs are a big piece. But beyond the mandates, what is it about New York? Even with remote work as an option, why come back? You hear people say there's no competitor. What does that really mean?
It's a unique mix. You know, it's not just the sheer number of opportunities or that you can find anything anytime, though obviously that's huge.
Sure.
It's more about the density effects, the random collisions, the serendipity. You bump into people, ideas spread faster, you have immediate access to culture, to events.
Like you could just be walking down the street and stumble into...
Exactly. You could stumble past Madison Square Garden and there's a Knicks game happening or a huge concert. That kind of dynamic, unpredictable energy, very few places can replicate that intensity and opportunity density.
And when we talk about who is coming back, is there a particular group leading the charge, a certain age group maybe?
Yes, absolutely. And this is fascinating. We're seeing a really strong influx of Gen Z.
Ah, the early to mid-20s crowd.
Precisely. They seem particularly drawn to Manhattan right now. And a big reason seems to be making up for lost time, experiences they missed during the pandemic.
Like what?
Well, think about it. Many didn't get a proper college graduation. Their first job might have been remote, not in a bustling office. Those kind of social rites of passage in a big city, they missed out.
So New York offers that chance to catch up. the fun, the experiences.
Exactly. The vibrancy, the sheer volume of things to do, people to meet, it lets them finally have that big city experience at a really formative time in their lives.
Okay, so you've got return to office, this inherent vibrancy, and now a wave of Gen Z seeking experiences, all pouring back in. What does that do to the rental market today? You mentioned $5,000 for a one-bedroom earlier. Give us the grim details.
The numbers are pretty eye-watering. A typical studio in Manhattan, you're looking at around $3,200 a month, average.
Wow.
A one-bedroom, generally around $3,900, maybe $4,000 plus. And a two-bedroom easily clears $5,000 a month.
And that's average, so higher end is even more.
Oh, yeah. In the newer, more desirable buildings, luxury one-bedrooms can hit $6,000. Two bedrooms, you could see $9,000, even $10,000 a month. It's intense.
With those prices, it feels like landlords must have all the power. What's the actual supply situation like? The vacancy rate?
You're spot on. They have immense leverage right now. The rental vacancy rate in Manhattan is just incredibly low. It's currently sitting at only 1.4%.
0.4%. That's basically nothing available.
Pretty much. It's a severe shortage. And that lack of available apartments, combined with this surging demand we've been talking about, it just lets landlords push rents to these levels. There's simply not enough housing for everyone who wants to be there.
Which brings us right to the affordability crisis. I mean, looking at those numbers, how does the average New Yorker possibly make it work? What's the income versus rent reality?
Yeah, the disparity is profound. The data shows that the average New Yorker would need to earn about twice the median income just to stay under that 30% rent-to-income guideline people talk about.
Twice the median income, just to meet the guideline.
Yeah. And the reality, most people renting in New York are spending closer to half their gross income just on rent.
Half.
Let's do the quick math. Manhattan's median household income is somewhere around $102,000. A typical rent, let's say $4,250 a month.
Okay.
That's $51,000 a year just for rent. So yeah, nearly 50%, sometimes more, of their gross income is just gone on housing. It forces a very different kind of economic calculation. Saving money often takes a backseat.
That's a huge chunk of income. Now, thinking about the cost per square foot, I've heard something kind of weird about New York pricing, like it's backwards compared to other places.
That's a really sharp observation, and yes, it often is backwards compared to, say, Florida or Texas.
How so?
In most markets, bigger apartments, more bedrooms, usually mean a lower cost per square foot, right? Economies of scale.
Right, makes sense.
But in Manhattan, it's often the opposite. The more bedrooms, the higher the rent per square foot can be.
Oh, what?
Scarcity. Simple as that. There's an extreme shortage of larger apartments, especially 3 or 4 bedrooms. So for families who need that space, maybe separate rooms for kids.
They're the only option.
Exactly. They become exceptionally valuable because they're so rare. Landlords can charge a premium per square foot for that scarcity. A $6,000 two-bedroom might actually cost more per foot than a $3,200 studio.
Okay, so despite these insane costs, the weird pricing, why do people pay it? What's the ultimate why, beyond just wanting the city vibe?
It really boils down to a few key things. One is definitely the unparalleled opportunity.
A career potential.
Yeah, especially in high-paying fields like tech, finance, real estate. Manhattan is still arguably the peak place to climb the ladder quickly.
Right.
So even if you're not saving much now, the potential to dramatically increase your earning power later makes the high rent feel like an investment for some.
A gamble, almost.
Kind of. It's often called a boom or bust city for that reason. Some people struggle mightily. Others leverage the network and the opportunities and really make it big. And then there's just the sheer experience of it all, the energy we talked about.
So it's opportunity and experience. Are there any new factors adding pressure, maybe at the higher end?
There is actually a really surprising trend here. The rise of the millionaire renter.
Millionaire renter. People with millions choosing to rent.
Exactly. A recent study showed something like a 150% increase in millionaires opting to rent apartments in Manhattan instead of buying.
Wow. Why would they do that? Flexibility.
Flexibility, maybe avoiding property taxes and maintenance hassles. Maybe they see better investment opportunities elsewhere for their capital. Whatever the reason, this influx of high-income renters is adding another layer of demand.
And pushing prices up even further for everyone else.
It definitely contributes. Their willingness and ability to pay top dollar for luxury rentals puts upward pressure across the market, and it makes it even harder for long-term locals or those on more moderate incomes to compete.
It paints a tough picture, economically. But you live there, you see it day to day. Are there any positive shifts, any improvements in the actual urban experience amidst all this?
You know, interestingly, yes. Anecdotally, and many people seem to agree, Things like homelessness feel visibly better than they did, say, 2 or 3 years ago.
Really? Especially where?
Particularly in really high-traffic spots like Midtown, around Penn Station, MSG.
Right.
Whether that's pandemic hangover easing or specific efforts by Mayor Adams, it feels calmer in that respect.
Okay, something.
And the city has continued to create more pedestrian space. Think about 9th Avenue, parts of 34th Street. They've carved out these large pedestrian ways that actually make walking around more pleasant.
Enhancing walkability.
Yeah. And you still have those only in New York moments, right?
Yeah.
You can still find a great $3.99 egg sandwich at a bodega. You see incredible things like the Vessel over in Hudson Yards.
That structure, yeah, cost a fortune.
$200 million opened in 2019. Or the massive Javits Center next door. There's always something new or interesting happening alongside the grit.
Okay, so rents are sky high. Millionaires are renting. The logical assumption is that buying real estate in Manhattan must be totally insane right now. A terrible investment.
That is the logical assumption. And it might be wrong.
Wrong. How?
This is where the data gets really counterintuitive. Despite those astronomical rents, Manhattan could actually be a surprisingly good place to buy property in the next few years.
Seriously, even with prices seemingly so high.
It goes against the grain, especially with bearish views on housing nationally, particularly in places like Florida or Texas that boomed recently. But look at the numbers. Condo values in New York City, they're actually down about 25% from their long-term norms.
Down 25% from the norm.
Yeah, and they're considered about 25% undervalued compared to their average over the last 2 decades.
Undervalued. That's not a word you hear often about Manhattan real estate. What about metrics like the price-to-rent ratio?
That's another key indicator. The home value to rent ratio in NYC is now around 18x. Now, 18 times annual rent still sounds high, right? A typical condo might be $1.1 million.
Yeah, it seems steep.
But historically, that 18x ratio is the cheapest condos have been relative to rents in Manhattan in 2 decades.
Wow. Cheapest in 20 years on that metric.
And it's not just rent. The home value to income ratio, also trading at its cheapest level in 2 decades in Manhattan. These are pretty significant signals for potential buyers.
So if you're an investor, someone with capital looking at the U.S. market, what's the takeaway here for Manhattan?
The takeaway potentially is that buying a studio or maybe a one-bedroom apartment in Manhattan right now could be one of the smarter real estate plays in the entire U.S. market.
That's a bold claim, especially compared to the Sunbelt hype we heard for years.
It is bold, and it signals a potential major shift. We might be entering a period where these legacy markets, New York, New Jersey, Connecticut, maybe even Illinois, actually outperform the Sunbelt states in real estate appreciation over the next 5 years.
A complete reversal of the recent trend?
Potentially, yes.
Huh?
It challenges a lot of assumptions about where real estate growth is going to come from.
That's a fascinating perspective on buying, but let's be real, New York isn't perfect. Even with these positive signs, what challenges are still very much present?
Oh, absolutely. Big challenges remain. Subway crime is still a major concern. You've seen the news, the National Guard deployment.
Right.
That reflects a real issue. And subway ridership itself, while recovering, is still down significantly, maybe 25% off pre-pandemic levels.
And that has knock-on effects, right? Fewer commuters.
Exactly.
Yeah.
Fewer people commuting in daily from places like New Jersey or Connecticut means less foot traffic for certain retail businesses, especially in Midtown maybe. Those shops are still feeling the pain.
And this whole New York story, the pandemic flight, the strong rebound, the weird market dynamics, does it connect to broader economic trends we're seeing?
I think it absolutely does. It fits neatly into this larger narrative of the pandemic boom-bust cycle.
How so?
Well, think about companies or sectors that exploded during the pandemic. Peloton is a classic example, right? Stock's way down from its peak.
Yeah, down like 75% or something crazy.
Right. Many things that boomed because of the pandemic are now correcting or busting. Now, flip that. New York's rebound is happening partly while some of those boom areas like the Sunbelt housing markets, Florida, Texas, are now seeing prices drop and inventories skyrocket.
So New York's gain is partly linked to their slowdown.
In a way, NYC's returning demand and surprisingly resilient home prices might even be taking some pressure off those Sunbelt markets, because fewer people are looking to move there now compared to 2021. It's all interconnected. Economic shifts in one region create ripple effects, winners and losers, often in unexpected ways.
It really has been quite a journey for New York City. From all that uncertainty, the death knell talk during the pandemic,
Yeah, predictions of its permanent decline.
to now, This incredibly vibrant, highly sought-after city, but also, let's face it, a really complex and challenging market.
Absolutely. We've seen this paradox play out. Rents through the roof, making it so tough for so many.
Yet, at the same time, these surprising signs of opportunity, especially if you're looking to potentially buy real estate.
Exactly. Hopefully this deep dive has given you a more nuanced picture of all the forces at work here. Something beyond the usual headlines, a real sense of the dynamics driving change in a place like New York.
So maybe the thought to leave you with is this. What does New York City's unexpected, powerful rebound tell us about the enduring draw of big urban centers, even when everything seems to be changing? And how might that make us rethink what truly drives value, what makes a city thrive in the long run?
Something to definitely mull over.
Until our next deep dive.